Hello. Good morning.
Good morning.
Good morning.
See you. Nice to see you all. Just gonna wait a couple of minutes and then we can get going. Can you hear me okay, everybody?
Yeah.
Okay, perfect. Thank you. Thank you all for coming. I'm going to start sharing my screen here so we can get going on time. This is a super packed session today. A lot of information, a lot of great information. Do you see my screen?
Yes.
I think maybe we'll just give a couple more minutes. I know we have quite a few registrants, but I do understand sometimes people get tied up. I just want to give a minute or so for them to join, and then we should take it away. This, like I said, is going to be super info-packed session. We're going to talk about the much talked about PPP loan and the PPP loan forgiveness. Zoom did this thing on me. Now I have to admit people as they come in. So forgive me as I turn my head around. This is, all righty. So we're going to talk about the PPP loan forgiveness process. We have the illustrious Melinda Pan she's the vice president at Chase Morgan. And she's going to talk all about the forgiveness process that Chase is going through. Admit. I'm going to talk about okay, I think I admitted everybody who wanted to be admitted. Oh, I'm sorry. This is going to be a little annoying because I keep hearing this admit me thing going. So I have to kind of turn my head around. So I'm super excited, and I'm going to be talking about tax reduction strategies for small businesses. Super, super passionate about this topic. One that I don't understand why anybody, well, we'll talk about more about that. Who am I? My name is Angie Bhasin. I am a CPA. I've been practicing since 2002. And I specialize in proactive tax planning. So honored and really humbled at the same time that I have been acclaimed as the Certified Tax Planner of the Year by the American Institute of Certified Tax Planners. I'm really super passionate about helping small businesses. And when I start talking about tax reduction strategies, I'll give you more of my background. And I do a lot of speaking engagements on this topic because awareness is extremely, extremely important about tax reduction, which is the biggest expense for any business owner. A little bit about myself. I love hiking and I love cooking / eating. I live in the East Bay with my family. And yes, I own it. I have been called a tax nerd a few times, but I do own it because I really do enjoy this so much, helping clients with tax reduction strategies. And now I'd like to welcome Melinda Pan. She, like I said, is the Vice President, Senior Business Relationship Manager at JP Morgan Chase. She's been working in the financial service industry for 30 years, and she's super active in the community. She's a board member at Oakland Chamber of Commerce, at the Crew, at the Asian Commercial Professionals. And I can vouch for her baking. She's a great baker. For fun, she likes to hike and travel, and she's very spiritual and does a lot of meditations. And the other thing I should say, not one thing, there's several things that bring us together, but the other thing is her extreme passion to helping her business clients as well. And I think that is a common thread between that brings us together in not only personal but professional arena as well. Our agenda for today, we're going to do an update on the PPP, dig deeper into the PPP loan forgiveness process since we have the expert here today. And then I'm going to talk about why you just cannot afford not to proactively tax plan. My goal today is to show you how you can take advantage of the Internal Revenue Code, just like the billionaires and big corps do, because, surprising, the tax code is the same for all. And then we're going to go into some tax reduction strategies that you still can take advantage of before the end of the year for 2020. So with that, logistics. Since we have a lot of information to cover, I think what we're going to do is go through the presentation and then take questions in the end. We might run the, how do I admit? Okay, admit. We might run a little over. I'll try not to. And then if there are still more questions in the end, we'll let you know what to do. And with that, I will give it away to Ms. Melinda Pan. Thank you.
Thank you. Thank you, Angie, for your kind introduction. And thank you all for joining us today. I know you are all as eager to get rid of this loan as you were to get this loan. So I am here to give you a brief overview as to how to apply for forgiveness, meaning how to get rid of this loan. Before I do that, I have a disclaimer. I am not here to advise you, but to guide you. You may consult your attorney or a CPA. And if you need one, I know one I can recommend. So now starting with the Sba Guidelines, just like the application process, the forgiveness process is also very fluid. It keeps changing. Therefore, Chase has just recently started accepting applications from the clients that got funded in April. So we are taking 2 to 4 applications a week. And if you have all the paperwork ready, I can send you the link to apply, and either you can apply yourself or I can co-browse with you to help through the process. So for that information, keep checking your chase.com profile, because we are sending constant emails as well as updating the information on your chase.com profile. So before you apply, you must know if you have exhausted all the funds. You may apply for forgiveness only for the amount you have spent. Remember, there's no rush to it. You have 10 months after the end of your covered period. So what is a covered period? It is the time you chose to use your PPP funds in. People who got funded before June 5th have an option of either using 8 weeks period or 24 weeks. So if you got funded in April, your covered period ends in September, and you have until May 2021 to apply for forgiveness. Or if you have a weekly or bi-weekly pay cycle, you may choose an alternate pay period. But you must remember, if you decide to choose an alternate pay period, you have to stick to that pay period throughout the process. So what are the documents needed to verify cash compensation and non-payroll and non-payroll costs? So the documents required to verify payroll costs are third-party payroll service reports or tax forms like 941 and state quarterly business and individual employee wage reporting and unemployment insurance tax filings, just like what you gave us when you applied for the loan, the 941s and your ADP or Paychecks, whoever does your payroll, the payroll sheet that you provided from them. And also with this, we need the payment receipts, your canceled checks or the bank statements documenting any employer contribution to the employee health insurance and retirement plans. So those documents are needed to verify your payroll or non-payroll costs. So next thing is for you to decide what forms to use. So when you're deciding to apply for forgiveness, you must know which one is the right document for you to complete. So if your loan amount is less than $50,000, you really don't have to worry because the bank, the SBA is going to forgive that loan, but they're not just going to forgive it. You still have to complete a form, but it's a very simple form, and that is called 3508S. However, this form is not out yet. So you have to wait until January 2021 to complete this form. But if you're so eager to ask for forgiveness and you want to apply now using 3508 or easy, you might have to do certain verifications for the SBA. So my suggestion will be to just wait till the form is out. So you may use the form 3508 easy. That is if you answer yes to any of these three categories, 3 points. One is you are self-employed, you are an independent contractor, or you are a sole proprietor with no employees at the time of the application, and you did not include any employee salaries when you calculated your monthly payroll. Or number 2, you did not reduce any salaries or wages by more than 25% during the covered period compared to January 1, 2020 and March 31st, 2020. These are employees who made less than $100,000, and you did not reduce the number of employees or the average paid hours of employees between January 1, 2020 and the end of the covered period. And number 3, if you are unable to operate your business during the covered period due to compliance to COVID-19 guidelines set forth by the state or federal regulations. If you answered yes to one of these 3 bullet points, you can complete the form 3508Z, easy. And if you did not, then you have to use the form 3508. So when you complete these forms, you don't need to complete the SBA loan number, the bank loan number, or the disbursement date, because we, the lender, will complete that information for you. So now let's look at the Schedule A, because Schedule A is a form that you must complete whether you are using a 3508 or you are using a 3508 EZ form. But before you complete the Schedule A, you need to get some numbers. You need to calculate some numbers. And for that, you can go to the Schedule A worksheet, which is the next page. So let's look at that first before we come to this page. So the worksheet has some columns, where the employee name. So all the employees, you must complete the first box with employees that were employed by you at the time of the covered period, during the covered period, or the alternate pay period, and those employees' principal residence was in the US or is in the US. So those employees, their names are listed, and you have to put their employee ID number. So the next column is cash compensation. So cash compensation is their salaries you provided to them during that covered period. And this annual compensation, these employees earned less than or equal to $100,000 in 2019, or they were not employed by you at any point in 2019. So basically, the table 1 on this worksheet is for employees that were making less than $100,000, or any new employees you added during the covered period. The table 2, that is list of all the employees who were employed during the covered period and received an annual compensation of greater than $100,000 in 2019. So that's the difference between table 1 and table 2. So the average FTE, that is the full-time equivalency, is the average number of employees on payroll per week between February 15, 2019 and June 30, 2019, or the average number of FTE employees on payroll per week between January 1, 2020 and February 29, 2020, or in the case of seasonal employer, the reference period is between February 15, 2019 and June 30, 2019, or between January 1, 2020 and February 29, 2020. The FTE reduction exceptions, they indicate the FTE of any positions for which you, the borrower, made a good faith written offer to rehire an individual who was an employee before February 15, and you were not unable to hire similarly qualified employees or for the unfilled position on or before December 31st, 2020, or the employees rejected the offer or were fired or voluntarily resigned or requested a reduction in their hours. Fill this in only if the position was not filled. So any FTE reduction in this case does not reduce the forgiveness amount for you. So then these numbers are then populated on the Schedule A. So we can go back to Schedule A. So if you look at it, the line 1 is the cash compensation box. You have to transfer that information from the worksheet. So same, the FTE box number 2 information comes back here. And also the salary or wage reduction from box 3 also comes back here. So the table 2, which is line 4 or 5, these are the cash compensation that you did on the worksheet. Those come back, get transferred here. And the non-cash compensation goes in line 6, 7, and 8. And what is non-cash compensation payroll cost? That is the employer contribution for employee health insurance, and also the employer contribution to employee retirement plan, and also the employer state and local taxes assessed on employee compensation. So compensation to owners. So that information we did not calculate in our worksheet when we worked on table 1 and table 2. So that goes in line 9. So this is the total amount paid to owner or the employer, self-employed individual. This is an amount, it is based upon your total compensation, capping it at $20,000 for $100,000 for 24-week pay period and $15,633 for an 8-week period. So you have to remember that, and that goes in your line number 9. And then you rest of the page, you talk about your total payroll cost will be, adding up line 1, 4, 6, 7, 8, and 9, that will be your total pay cost. So FTE reduction, safe harbor, that we talked about. So all those, line 11, 12, 13 talks about, what reference period you have chosen. That will talk about the average FTE during that period and total average FTE that is between and adding line 2 and 5. So, I might have gone over quickly on this, but I'll be willing to sit down with you one-on-one and talk about this if you need to. So going to the next page, which is talking about the formula for forgiveness. Okay, so you can ask for forgiveness if you spend at least 60% of your loan amount on the payroll cost. It used to be 75%, but then it got changed to 60%. And now if you spend 40% of that on your non-payroll cost, that will qualify. But if you spend 100% on payroll cost, that's even better because you don't have to send in any additional paperwork. So all you have to do is send in your 941s and your copies of canceled checks and bank statements. So as I mentioned, the owner compensation is based upon on a 24-week period. It's, to be exact, is $20,833, which is 2.5 times, 2.5 month equivalent of 100,000 per year for each individual, or the 2.5 month equivalent of their compensation in 2019, whichever is lower. For an 8-week period, this amount is capped at $15,385, which is 8 weeks divided by 52 of your 2019 compensation. So after you submit the application, you have to remember it will take Chase 2 months to submit the application to SBA, and SBA could take up to 3 months to give their decision. So you have, if your loan is not fully forgiven, your payments will start after the SBA has given you their decision. And if you got funded before June 5th and your loan term was 2 years, at that point, Chase will notify you that you have 5 years to pay that loan back. The interest rate is 1%. And if you received an idle loan, your PPP loan forgiveness amount might be reduced up to $10,000 because of the idle loan. And lastly, if you are planning to sell your business, you must notify the bank and the SBA before you do that. Otherwise, you will be considered in default. So let me clarify something here. If you are selling only a portion of your share, like 25%, you will be forgiven. That will not affect your forgiveness. So it is only if you are selling more than 50%, then you must notify the bank. And you have three options, if you are selling 50% of your business, because either you can, the best thing is, to pay the bank back, or you pay down the remaining balance on the PPP loan and then proceed to the change of ownership. And second option is submit a forgiveness request to the SBA. And once the forgiveness payment is received from the SBA, which could take up to 5 months, then you pay down any remaining balance and proceed with the change of ownership. And the third option is you submit a request to the SBA for approval of change of ownership. And in that case, SBA may take up to 60 days to renew this request. And there is no guarantee that your forgiveness will be, your change of ownership will be approved. So if it's denied, then your best option is to wait till you either pay off the loan and then sell the business, because otherwise, as I mentioned, you will be considered in default. And PPP forgiveness, you must apply for it. It is not automatic. So you have to submit an application. And at Chase, if you originally applied for it manually, then your forgiveness will also be submitted manually. And if you applied online, then you can go and apply online. And you miss, if you have a balance that's not forgiven and you want to pay back, you can pay back at any time because there is no prepayment penalty for this loan. And since you have 5 months, 5 years to pay back, your interest will start accruing, even now the interest is being accrued, but right now it is in the deferral period. So once the deferral period is over and the SBA has given a decision on your forgiveness, then you will start to pay interest if your loan is not fully forgiven. So one last thing I would say is that for any changes, because it's a fluid process, as I mentioned, you should keep watching your Chase.com profile, and also, look for your emails, because we keep updating the forgiveness process as we get the changes. So anytime you have any questions, you have me and you have your CPA to go to, to ask questions. And remember, it will take us, it will take the bank 2 months to submit, and it will take SBA 3 months. So you need to give it time, to get the forgiveness process. No need to panic. So with that, I will leave it up to the end for you to ask questions, and I will give it back to Angie for her advice on tax reductions. Angie, take it away.
Wow, thank you. That was boatload of info. Thank you so much, and very valuable info. I know a lot of my clients they do have a lot of questions on this. So thank you very much again. Appreciate it. And I did put a note in the chat box. If you have questions, you can feel free to start dropping them in the chat box, and then we can address them towards the end. Now let's talk about the topic that I love to talk about. I'm not a big talker generally, but when it comes to taxes, I do tend to talk a lot. So don't know how that happens. I'm going to start with this quote from Chief Justice William Rehnquist, and he even the Chief Justice has said that there is nothing wrong with the strategy to avoid the payment of taxes. We are required to pay our fair share of taxes. We're not required to pay the maximum amount of taxes. And there is, like I said, there's nothing wrong with the avoidance of tax. It's the evasion of tax, which is a crime. And we all know that, big companies, Amazon, Apple, I mean, they make billions of dollars. Amazon actually made $13 billion in 2018, and they paid, do you know how much in taxes? Zero. In fact, they got $120 million back from the IRS in tax credits. We all heard about the Trump tax return, right? So it's not that they are doing something illegal. It is that they have the resources that are even the tax departments, really, not even tax professionals, tax departments who are working with them to reduce taxes. It's not really a myth that the rich pay less tax. They plan better, and they have good team of proactive, forward-thinking planners who are on their side. And that's really, if there's anything that I want you to take away from today's webinar, is planning. And I'll tell you, traditional CPAs don't have the knowledge or the bandwidth to provide these forward-thinking, proactive tax planning strategies that you need and you deserve for your business. And I know you might say, oh, how do you know that? How can you be so sure? Like I said, I'm a CPA. I've been practicing since 2002. And for a number of years, I worked just like all CPAs do, helping my clients with tax filings, accounting, consulting. And I truly believed, as do most CPAs, that I was helping my clients with planning to save them on taxes. You see, prior to starting my own firm, I worked at large and small firms. And when our clients asked us for strategies to reduce their taxes, we gave them strategies, the same strategies, standard strategies, which is limited to buy some equipment, prepay expenses, buy some, pay out bonuses, or even put away in a retirement account. Those can be all great strategies, but they're a very small portion of the overall holistic advanced reduction strategies. These strategies all require taxpayers to shelve out monies to get deductions, right? And that's not really the extent of tax planning. That's not proactive tax planning. Proactive tax planning is using the Internal Revenue Code, structuring it so that you make expenses that you would normally pay in a tax deduction, and creates tax strategies, right? And so not the expenses that you would normally pay with after-tax monies, you structure it using the Internal Revenue Code, doing everything legally, and getting a tax benefit out of it. As CPAs, we're trained to prepare tax returns using historical data, but really that's not where the value is. The value is in providing strategies and structure for the taxpayer to really take advantage, to really reduce their taxes, not just figure out how much taxes to pay. So when I was working in these firms, I wanted to help my clients better. And every time we were giving these standard strategies, even the partners of the firm would say, that, sometimes they would say, oh, you made more money, so it makes sense that you would pay more taxes. But then you see all these Warren Buffett and all, so that's like, okay, that's not, something's not right. So that's when I made it my mission to find answers so I could help my clients better. And that's when I took extensive training and certifications in proactive tax planning, with the focus of helping my clients take advantage of the Internal Revenue Code. The Internal Revenue Code is more than 80,000 pages long, and the majority of these pages talk about deductions that you as the taxpayer can avail of, just like big corps. But unfortunately, small business owners are not getting the same advantage as the big corps are of the Internal Revenue Code. And I have found this to be a classic case of you don't know what you don't know. You see, when I first talked to business owners, they'll insist that their preparer, CPA, EA is taking care of planning for them, right? They just assume that they're taking care of planning. But when we discuss further, we discover the unfortunate truth, really, which is the preparers are so focused on preparing tax returns that they are not taking advantage of everything that's possible to reduce taxes. And I've found that 100% of the time, when I get these new clients, they have been overpaying anywhere from, $10,000, $11,000 to sometimes over $100,000 in taxes year after year. And that's why I'm so passionate about bringing this, first, the knowledge of proactive tax reduction strategies, and then the service. So to add, at least the knowledge I can give to as many small business owners as I possibly can. The service, as we'll talk about later, I'm a boutique firm and I take on clients with certain criteria. And I'll mention that to you. We strive to provide an ROI of at least 200% to our clients. And I'll mention more about that later. As a business owner, I know how hard it is to earn money. And I know for sure you don't need to donate it to the IRS. I'm sure you'll agree that that's not the best use of your money either. And so really what I want to do today is help you understand how you can too take advantage of the Internal Revenue Code and reduce your tax liabilities. I mean, imagine what you could do with 10, 20, 50, $100,000 back, instead of donating to the IRS. You could invest it in your business. You can put it away in your retirement. You can pay for your children's education. Heck, you could even take a nice vacation, right? So that's really what I would like you to think about as you work so hard on your business. I mean, when was the last time your tax professional called you up to discuss tax strategies that could save you taxes? So seek out and invest in a relationship with a proactive tax planner who will help you save money instead of costing you money. Yeah, costing you money. The all the time when you're not actually utilizing the code to save you money, it's been costing you. So I'll get off my soapbox here. Well, this best way to really, I love this quote. The best way to predict the future is to create it, and nothing could be more true when it comes to taxes and tax planning. Think about it. Working with the tax plan and implementing the plan can really be your best investment in the business. You can spend thousands of valuable dollars in advertising and marketing with the goal to increase your revenues, but you don't know how that's going to turn out. But when you're working with a blueprint of customized tax plan and you're implementing it correctly, you are guaranteed those savings. You're really carving those savings out intentionally. And that's what we're going to be talking about today. I must tell you, I have to give you a disclaimer. This is not tax or legal advice. This is for information purposes only. I'm required to let you know that. So what are the keys to cutting taxes? There are several different buckets, really, of tax planning strategies. So first is timing-based strategies. Think about this as, say, 401k deferrals to shift the balance, to shift your tax burden from now until later, until you withdraw your funds, right? Then is shifting, which is basically shifting income from a higher tax bracket to a lower tax bracket, or a higher tax year to a lower tax year. Then there's the code-based strategies like Section 105B, and we'll talk about some of those later during the presentation. And of course, then there's product-based strategies, which would be like insurance and annuities. How does tax planning actually work? Now that we know what our goal is, which is to find and exploit the Internal Revenue Code's provisions to help us save taxes, let's take a look at the process. So it kind of works like going to the doctor. If you're sick and you visit the doctor, typically three things happen, right? First, the doctor's going to examine you and diagnose the problem really. Does your stomach hurt? Maybe it's food poisoning. Maybe it's something more serious. Maybe, hopefully not, it's cancer. So regardless, whatever it is, the doctor has to first figure out what the problem is before they can solve it. Then the doctor prescribes the solution. What is it going to take? Somebody has to take that to get the prescription filled. Maybe the prescription involves just going to the pharmacy and getting medication. Maybe it means surgery. Maybe it's physical therapy. But regardless, whatever the problem is, it's not going to fix itself, right? So tax planning works similarly. The diagnosis really takes the form of a tax discovery session. This is where we sit down with you, look over your business and your personal tax returns, look at any supporting documents like you may have, really go over your goals and exit, and really find out more about you, your goals, your needs, and then we diagnose any mistakes or missed opportunities that may have been costing you, and making you overpay on your taxes. And then the tax plan actually is the implementation, which is the filling of the prescription. So this may include implementation guides, checklists, forms and templates. We might be referring you to specialists, estate planning, attorney, financial planner. We have all of this in-house. We're a family office firm here with all the power partners, a lot of heads looking at our clients' stuff for their benefit, and then helping the client implement it. At our firm, we actually provide a complimentary tax discovery session to learn more about our clients' needs and goals. And then, that's the time when we also see how we can help them, what value we can provide, and whether it's a good fit to work together. And like I said, we strive to provide 200% ROI on the client's investment to work with us. So this is a great example of one of our clients. These amounts are rounded, of course. In this case, we helped our clients save, they were paying $235,000 in taxes approximately, down to $174,000, which was $61,000 of savings for them, enjoying an ROI of 281%. That really is the power of tax planning. That's why you really cannot afford not to look at how you can help save your business and yourself money. Now let's go ahead, dive into some year-end tax planning strategies that I wanted to remove. Okay. I want to discuss with you. Okay. The first one is a number one opportunity and also the biggest mistake I see business owners make, and which is choosing the wrong business entity. Most business owners will start as sole proprietors, which is fine, and as they grow, they establish an LLC or a corporation to help protect them from business liability, which is great. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners operating with entities that may have been appropriate when they were established, but just don't work effectively anymore. And with the 2017 TCJA, Tax Cuts and Jobs Act, it was just made even more sense to evaluate your business entity. And I'm going to talk a little bit about these entities, and I can't make you an expert in business entities today, but I can help you diagnose some common problems that might be costing you taxes that you just don't have to pay. Let's start with one problem I see a lot of business owners make, and that's paying too much self-employment tax. Like I said, most businesses start off as sole prop, and then which means the business is taxed as at the 1040 level, and they report the income on Schedule C. Now, this Schedule C income is subject to regular income tax, but it's also subject to self-employment tax, which is 15.3%. And it's on the first, for 2020, it's about $137,000. And plus you pay 2.9% on everything else, plus potentially you're also paying at 0.9% of additional Medicare. So you see, taxes add up. Now, and what is the alternative to that? Is establishing an S corporation may sometimes solve the problem, because what it does, it divides your net income into two parts, one of which is subject to self-employment tax and the other that's not. So the corporation, the way it works is the corporation will pay you a salary for the service you perform as an employee. You'll get a W-2 for that amount, just like any other employee, and the rest of the income will pass through to your personal tax return. I won't go into too much detail, but just to let you know that that can be a viable alternative. However, you don't want to assume that S Corp is the optimal entity for you, because sometimes C Corps, and like I said, especially with the TCJA, we've seen so many times that perhaps S Corp was a viable entity for a business owner. It's not necessarily, it still is. So what I'm trying to say is make sure that that's evaluated and you are not overpaying in taxes just because you are not in the correct entity. Last month, we were working on a tax plan, and we saw that because the client's business was in the wrong entity, he was overpaying by $18,000. It was 18,800 some, I don't remember what it was, in taxes year over year. Yikes. That's not necessary, and that's not pleasant news. So needless to say, we were able to help him going forward, but it makes me really sad that he was overpaying so much in taxes all these years. And that's because he thought and he realized that his tax preparer relied on that his tax preparer was planning, but obviously he wasn't getting the planning. So make sure to stop that bleeding. And I'm really glad you're here and you're educating yourself on that. Now, I do want to point out one thing on the reasonable salary is a huge audit alert for an S Corp. So you might say, okay, if I can take a portion of my income from an S corporation and not be subject to self-employment taxes, well, why don't I just not take any salary? And then I escape all self-employment taxes. Well, the IRS requires you to pay a reasonable salary, and yeah, you guessed right. Why? Because they do want a share of the payroll taxes. But they don't give any guidelines what a reasonable compensation should be. So, and that's not very easy to determine. So careful analysis have to be done, because if it's not reasonable, you can be stuck with a bunch of payroll tax liabilities and penalties and all of that. We actually have a tool that calculates what your reasonable salary should be, and that has been blessed by the IRS in audits. I'm gonna, I know we're kind of late on time, so I'm going to rush through a lot of these. But if you have questions afterwards, feel free to chat in, or even you can email them to me later. Accountable plan. This can be a really, really powerful strategy of how you can turn your everyday expenses into tax savings. So what you do is, if you're an employee, I mean, all the strategies that I'm telling you are if you have other employees, or you are the employee of your own corporation. What you can do is you're able to use an accountable plan and get your business expenses reimbursed by the business. So not only does the business get a tax deduction, which lowers your taxable income and hence your tax liability, but also lets you get tax-free cash out of your business. And this is a huge, huge benefit. But again, you want to make sure that you're following the IRS code and implementing it correctly. I do see a lot of times folks deducting all sorts of personal expenses through their business without the proper not within the code and not using the accountable plan. This can create a huge risk. If the IRS were to audit, all of those expenses would be classified as payroll. And then, like I said, you'll be stuck with hefty payroll taxes, penalties, and interest, and you don't want that. So doing it right and documenting it correctly is very, very powerful. The next one I'm going to touch on is non-deductible medical expenses, your out-of-pocket medical expenses. If you pay for your own health insurance, you can generally deduct it as an adjustment on your 1040. And if you itemize deductions, there's only a certain, if your medical costs are over 10% of your AGI, that's the only way you can get benefit. But this code section that I'm going to talk about, this is what I alluded to you earlier too, 105 lets you write off your medical bills as business expenses, and you don't lose them just because you have that 10% floor for Schedule A. What this lets you do is lets you reimburse medical costs incurred for yourself, for your spouse, for your dependents. Like I said, you're not subject to the Schedule A floor, the 7.5% or 10% floor, and you avoid self-employment taxes because it's a business deduction. You can, eligible expenses are any one of these copays, deductibles, braces, fertility related, all of these can be structured so you can take advantage of deducting these from health savings account. A lot of you may be aware of. If you're not aware of, that's another very, very powerful tool. It can only be used though in combination with a high deductible health plan. And it really has, it's kind of like an Roth IRA in the sense that the account grows tax-free and tax-free withdrawals if you take distributions for qualified expenses. But this is even more powerful than Roth IRA because you get a deduction at the upfront too, at the contribution too. I'm trying to go really fast here. Hiring your children can be very, very terrific strategy for taking income that would otherwise be taxed at your higher rate and then shifting it to them at their lower tax rate. And really, I think this is a very super powerful strategy, not only from financial purposes, but also to teach your kids the value of money. Again, the benefits are you're shifting, sometimes eliminating tax, because if the limit is 12,000, I believe 12,400 this year, if you pay your kids under that amount, they don't even have to file a tax return to report it, and yet your business gets a tax deduction for it. It boosts your QBI, which is a qualified business income. topic for another day because it's really, really deep. But then the payroll to the kids, then what I always advise is, sure, they can use some of it to pay for their expenses that generally you would be paying with after-tax money. Maybe it's soccer camps or even, private schooling or whatever. So this is a way to structure it so that you're getting a tax deduction for their private school. And then, but I always suggest is to take a portion of that, which you guys can decide with your kids what portion that would be, and invest it in a Roth IRA, so to get their retirement plan started early. Huge benefit of this. Again, some of the mechanics, how that works. That's going more into the detail. I'll just move on to the next topic, which again is a very, 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 very powerful strategy. It's kind of like a hidden strategy that most advisors are not even aware of. And the reason is this gets triggered only at times of federally declared disaster periods, which we are in right now. So this came about at the time of 9/11. And as you can imagine, this code has not been used much, so there's not too much guidance on it. But basically what this says is Code Section 139, it pretty much says it allows you as the as the employer to take a deduction for personal expenses that you are reimbursing your employees for, and it's not taxable income to the employee. Again, can be really powerful if you want to compensate your employees, your loyal employees during this period, helping them out, and because everybody's going through a tough time. And then if you don't have employees, remember, you are the employee of your corporation, and this can be structured for yourself as well. You can, medical costs, funeral costs, childcare, tutoring expenses for employees' children. I mean, if I had time, I would give you examples how my clients are using it, but we're kind of short on time. If you're setting up an additional home office, then expenses related to that. I'm going to touch really, really briefly on some other year-end strategies that you can avail of. This is something new for 2020. Generally, charitable contributions, you could get advantage of it only if you itemized your deductions. This year, they've added a line item for non-itemizers to take a deduction of $300, which is $300 per tax return. So it's not $300 for taxpayer and spouse. It's $300 for married filing joint tax return. Donor advised funds can be a very super powerful strategy at year end. We help our clients with a whole bunch of these. Then again, bunching your deductions, seeing what makes sense, whether you take your deduction this year or defer it until next year. Where is your higher tax bracket? So it's all a planning process that needs to go through. And something different for this year, you can get up to 100% deduction of your AGI if you donate to public charities for 2020. A few other tax saving ideas: changes to NOL rules, very powerful if you have a business that's struggling or you are in a not in a great position this year. There are strategies that you can avail of that can get you quick cash by amending prior year returns. Qualified improvement property is now eligible for bonus depreciation. TCJA had kind of taken that away, but now it has been reinstated, and there was a glitch and they fixed it in this CARES Act. Employee retention credit, up to 10K per employee. Now, just to make note, if you got PPP funds, then you cannot take advantage of this. But if you didn't, then this can be a really powerful thing for you to avail of. Again, quickly, there's under the CARES Act, you can take out up to $100,000 of distributions from your retirement account, not pay penalty on it, and you can pay tax pro rata over the next 3 years. This can be very beneficial in some cases. You know, if you need the money, I'm not a big proponent of taking distributions from retirement funds, but in some cases this could make a lot of sense, especially if you think, okay, you know, you're going through a hardship right now, you take the distribution, and at the end of the third year, you may decide, because the provision is there, if you don't need the money and you want to put it back into your retirement fund, you can do that. So it's kind of like a interest-free loan. Or it can be distribution and you pay taxes on it, 1/3, 1/3, 1/3 in the 3 years. You can take loans from your 401k up to $100,000 and repay them back in 5 years. Set up a DB plan. This can be very powerful if you're in a situation where your business is doing way better and your income is much higher than you projected. This can be very beneficial to you. If you have large capital gains that you have encountered in 2020, then there are options that can help you mitigate and sometimes even eliminate taxes. So again, so important to be in a relationship with your tax advisor, tax planner, CPA, that you have ongoing communication throughout the year. And that's something that we really strive for with our clients. We're not the firm that, and that's one thing I hated about, public accounting model is the hourly billing. I don't want my clients to be thinking before making a phone call, oh, the meter's going to start running. The way we work is it's unlimited communication, which it's a win-win because it allows my clients to not have to think about picking up the phone or emailing us with questions before they take action. And so we're not after the end of the year or at the end of the year, we're like, okay, how do we undo what we did if it was wrong? So planning for 199A maximization. 199A is, again, the qualified business income deduction that I mentioned earlier. I am over on time, but this is what I wanted to share. Again, there's so many more strategies. We obviously cannot. I mean, there's hundreds of strategies and thousands of combinations that can work in your situation. That's about all we have time for today. Please connect with us. What I can do is we have your contact list. We can put you on our mailing list. And if you decide you don't want that, you can always opt out. But we're constantly emailing out newsletters and tax newsletters and tax alerts. So we're big on education, as you can tell. And if you'd like to schedule your complimentary tax discovery session, you can do so on our website or Calendly. My Calendly is Angie -Tax Pro. And that's about it. That's about our firm. I am so happy, and I'm going to go ahead and see if there are any questions that I can answer.
Yeah, there's one question, Angie, I saw in the chat box.
Uh-huh.
And that is about the worksheet that we said that the client, if the question is, on the PPP Schedule A, do employers need to list every employee, or can it be an employee count and compensation total? The answer is you don't need to list every single employee. If you have a payroll sheet from your payroll provider, just attach that, because that will have all the details that you need on this form. Other than that, if anyone has any other questions, then feel free to reach me or my clients that are on the webinar, they have my contact information. And if there are others that I don't have a chance to work with yet, please reach out to Angie, and she knows how to reach me. And I'll be happy to provide any information that you need. And I'm sure similarly, Angie would be happy to do that as well.
Absolutely. Thank you. There is a question from Adrian Lopez. I'll read it out. I think it was sent privately to me, so you can see it. The initial $10,000 EIDL SBA loan is forgivable, correct? That's correct. It's actually not a loan, it's an advance. So it's free money. Unless you have PPP, then it's like Melinda G said, it's your PPP loan forgiveness is reduced. As of now, I have it as a loan in payables. What entry do I need to make to clear it? If we receive the PPP loan in May, we have the option to spend the money in 8 or in 24 weeks, correct? When do we start applying for the PPP loan? I thought we were still waiting on resolutions. Yeah, you're correct on all of them, right, Malinder Ji?
Yes, yes.
Great. I don't think we have any more questions. I want to thank you all for attending. And like Melinda just said, please feel free for your banking needs and any questions. She would be happy to help you. And if you have any tax related, if you would like to schedule a tax discovery session. Thank you, Anjali. I appreciate that. We would love to help you. Again, sorry we went a little bit over, but I hope you got some good information out of this.
Thank you. Thank you all. Have a good day.
Thank you.
Bye-bye.
Bye-bye.